Well, welcome to All Things Retirement. We've produced hundreds of retirement income plans over the years for families. And even though every family situation is unique, there are some common questions that consistently come up for people. Questions like, when can I retire? How much after-tax income can I generate? What kinds of returns do I need to achieve in my portfolio? Those are just some of the questions. So in this video, we're going to talk about the return question. How much return do I need to get on my retirement income portfolio? So we'll not only talk about that particular question and how to solve it, but we'll also show a case study and how we looked at that particular question for a family and gave them clarity on what they needed to do with their portfolio. My name is Shaun Humphries, and if you're getting serious about retirement income planning, go to the show notes to link to some free resources you can tap into. And if you're looking for a second opinion, there's a link back to our website to find out how you can get our gap analysis discussion and second opinion. Okay, the first thing when it comes to retirement income planning is the fact that there are some key investment challenges that we need to contend with. Now, as we've worked with families, we've found that there are some common challenges that get in the way of successful investing. And most of these challenges are more psychological or emotional. And I'm going to go over a listing of them. And I can guarantee you that if you're not retired yet, you will probably experience some of these particular frames. And if you're not conscious of them, they can negatively impact your approach to your investment planning. And so investment planning needs to be very clear-eyed and tied to the numbers of your forecast and your retirement income plan. At the same time, you'll see your emotions and psychology superimpose itself on top of your decision. So what are some of those frames? Just generally increased fear of loss. So as people, get into a period of massive transition, and retirement is one of those transitions that's pretty significant, they become more sensitized to the uncertainty around them, whether it's geopolitics, whether it's the economy. They just get a little more fearful. It might be low grade, but it does impact decisions. The next one is psychologically retirees become just more conservative generally. So they get more concerned about preserving capital. That's an overarching goal for some people. It may not be realistic. We've done hundreds of plans. The majority of retirees do have to use some of the capital over time to maintain cash flow. It's not realistic for everyone to be able to have the goose that lays the golden egg, to never, cut up the goose, but just take the eggs. That's usually not realistic for most people. But the way you can get comfortable with that decision is making sure you've got a good analysis in place with lots of stress testing so you know that your plan is solid. The next one is people feel emotionally sort of exposed or naked. So the whole idea of going from working full-time, maybe having a business, in the process of maybe selling your business, and you just feel exposed financially. And it's a very uncomfortable feeling. And part of that is the idea of moving from accumulating capital to deaccumulating to fund cash flow and lifestyle. That is very destabilizing psychologically for a lot of people. So I can guarantee you, like with our clients that we work with over the years, helping to manage their portfolios, they get used to it. They get past that kind of feeling of being exposed or naked, but it's a real issue in the first 1, 2, sometimes 3 years of retirement. And good solid planning gets people past that point. And they also sometimes say that time is not on their side. So I'll talk to a 60-year-old and they kind of feel like they've got to be more conservative, which maybe they need to be on part of the portfolio. But the reality is they have maybe another 3 decades ahead of them. So to be too conservative could actually inflict some negative consequences. You want to have a portfolio that's structured to be clear-eyed around money that's needed in the short term, but also there may be money that's not needed for a long period of time. And so the portfolio has to be nuanced to cover both those kinds of timelines. Now, when we design a portfolio and try to confirm what return goals we should aspire to, we need to understand that our default position temperamentally for most people retiring is to be conservative. So again, go back to the concerns we just talked about. Fear, anxiety, concern, capital preservation. So at the end of the day, the default position is conservative. And if I take a look at this particular bullet point here, the question to ask yourself really is, can you achieve your retirement goals by purchasing GICs, high yield savings accounts, and T-bills? Now, intellectually, you might already say to yourself, well, I don't think that would be the right strategy. Like, I think I need to be more nuanced in my approach to investing. But in an ideal world, if I could just put my money in guarantees and achieve my goals, that would be awesome. So actually, when you take a look at the case study in this video, when we get to it, that's the approach we take with clients. We just say, okay, here are your goals. Here's your asset base. pensions, government benefits. Yes, let's use a risk-free return and see how long you can fund your goals for. Now, again, it's not very common, but some people can fund their retirement income goals using risk-free assets. And if that's the case, awesome. Don't take on more risk financially than you need to. That's not common, but that's the first thing you need to confirm. What level of financial comfort can you achieve using risk-free? And if you can't achieve your goals, then you might have to sort of look at some other strategies. So part of the way you want to look at this is one of the challenges around retirement income plan, is the next question, which is, what's your net return? Like, what are you actually making at the end of the day? So when we look at risk-free assets, let's use an example of 5-year GICs. Let's say they're making 3.5%. And I look at the inflation rate, the CPI is 2.4%. So I'm losing some ground from inflation. And then I look at the marginal tax rate, which is 30%. And so I'm losing about just over 1% of the total return to tax. So 2.4% is gone in inflation, 1.05% is gone because of tax. So my net return on a risk-free asset is about 0.05%. And if I use the core inflation numbers, which will be a little higher, I'm actually in negative territory. I'm minus 0.55%. And basically that's going broke safely. Because that's one of the risks for most people. And when you take a look at the case study, that's what the clients are going to find out. When you use the risk-free return, they can push, their retirement goals for quite a long time, but eventually the inflationary and tax pressures get in the way of their retirement income objectives. So before we get into the case studies, I just want to underscore why this is such an important topic. And so really the question I would ask you is, what's at risk here? Like, what's at stake if you allow your concerns and anxieties psychologically and emotionally to override the investment decisions that you need to make? And you need to be a little bit open-minded about, okay, what do I need to do, first of all, from a return standpoint? We'll answer that question in the case study. And what does that look like as an investment portfolio? And then finally, how much risk does that expose us to? And we actually will run in the case study, we'll quantify how much risk the client's taking on if they have to achieve or build a different kind of portfolio structure. So what are the risks? Well, the first risk is, if this category of planning is not handled properly, is reduced retirement income. The next risk is loss of purchasing power. And then, of course, account value erosion. If you don't want to kill the goose that lays the golden egg, one of the ways that you'll almost guarantee killing the goose, if you're not nuanced and a little more sophisticated in your investment planning, is by just buying guarantees in your portfolio. And then you'll end up paying also, in many cases, excessive tax. And we've been doing this a long time. And so as we meet families and talk to people, there's a lot of regret and even worry because people have been too cautious in their portfolios. And there's a way of managing accounts to deal with that risk around volatility. But if you're too cautious, you could actually hurt your long-term retirement income planning. So as we go into the case studies, I want you to keep in mind our motto. And our motto is, don't take more financial risk than is required to achieve your retirement goals. And the way that you're going to quantify that is get a retirement income plan conducted that starts with risk-free. And then if you can't achieve your goals with risk-free, how much do you need to change in your portfolio structure to achieve your goals? And how much risk does that put you in terms of the structure of those accounts? That's what we're going to answer in the case study. So as we seek clarity in this area, we're going to develop a scenario, like I said, where we're going to use guaranteed investments. We're going to see if there's shortfalls and then what the trade-off decisions will be, which will be a combination of changing financial goals or changing the portfolio mix. So let's take a look at the case studies. So we were talking to Tom and Sally. They're in their 62nd year and they're transitioning into retirement. And so we're going to take a look at 3 different models for them. One is a risk-free portfolio. And then we'll look at the results of that. And if we need to adjust the portfolio mix, we'll take a look at that as well. And then we also look at what's called a randomized or sequence of return model to see how much additional risk, if they take it on, how that impacts potentially their retirement income planning. So the first thing we'll do is we'll take a look at their goals. So they want $90,000 per year of after-tax income. And that's inflation adjusted at 3%, and it continues all the way through until they get into age 80. At that point, they wanted to have a bit of an increase in expenses, taking into account potential health expenses, long-term care, that kind of thing. We built that into the budget. And then in addition to that, they had some additional travel expenses of $15,000 per year indexed, through to their 70th year. So those are their key expense numbers. And if we take a look at their benefits, again, we have them taking their Canada Pension Plan, basically at age 67. The reason we did that is it made sense for them to take CPP at about that point. The numbers that we crunched for them, old age security, they were going to take at age 65. And we took a look at their balance sheet. So let's take a look at that right now so you can see what numbers we're working with in this particular case study. So here are the details for their net worth statement. You can see that they have a total of $1.3 million essentially in financial assets. They have an open portfolio, jointly registered for $250,000, TFSA for Tom of $120,000, TFSA for Sally of $140,000, RSP for Tom of $400,000, RSP for Sally of $400,000. Their residence is worth $900,000, so the total net worth position is $2.2 million. So we've taken a look at some of the key assumptions. Again, we're using a 3.5% risk-free return in this model. The purple here is their after-tax expenses, and you can see they do go up for the increased expenditures for long-term care or assisted living as an example. And then you can see in this dark blue here, that's the travel expenses. And you can see in terms of the model, they're beginning to run some shortfalls beginning at age 85. And we'll talk about that in a minute. In terms of the drawdown of the portfolio, they're taking money from their RIF account in this green, the yellow from their non-reg, and those two accounts last basically until age 78. And then at that point, they're going to the TFSAs. They peel through all their TFSA value by age 84. Not a bad outcome for a risk-free portfolio, but you can see the shortfalls begin to emerge here in the model. So the shortfall out to age 90 ends up being $397,000 of shortfall value. So they weren't crazy about that. And, all in all, not a bad model, given that we're using a risk-free return, but they don't want to see the red there. So they're open to the idea of, changing their portfolio mix a little bit, adding a little more growth to the portfolio to see what the ripple effect might be, so they can then make some decisions around their portfolio strategy. So let's take a look at that. Now, in this model, every other input in the retirement income plan is exactly the same, but what we've changed is the investment allocation. So in this allocation between cash, fixed income, and equities, in the projection model, it's an equal weight between Canadian equities, U.S. equities, and international equities. Now, what you can see here is under cash or cash equivalents, we've got 35% of the portfolio in GICs, high yield savings, T-bills, and we're assuming a return of 3.5%. And if you look at the remaining 65% of the portfolio, it's in high quality equities, generating a total return of 7%. Of that total return, 50 or 40% is going to be an equal allocation of dividends between Canadian and global, and the remaining 60% of the total return will be price appreciation on the securities. So if we're running a 35-65 asset mix, that's going to give us a weighted average return of 5.78%. So keep in mind the other model was 3.5, now we're using 5.78. Again, Tom and Sally do not want to integrate real estate value into these models, but they did want to see, using this revised asset mix, how does the analysis look? Now, what you see here is the cash flow report. Again, the purple is the basic expenses. Again, we see it moving up a little bit in terms of healthcare, long-term care, assisted living. We've got the dark blue, which is a top-up for travel expenses. But in this model, there are no shortfalls, so they're fully funding all the expenses. If we take a look at the drawdown, you can see here we've got the non-registered portfolio fully depleted by their 70th year. We've got the RIF accounts basically lasting until age 82. And then we've got the TFSA accounts used in earnest beginning into their 83rd year. The bottom line on this analysis is that they have sufficient assets to meet their spending goals so that by the time they get to age 90, they theoretically have fully depleted the financial assets. They still have real estate, but if they adjust the asset mix, then potentially they could achieve their long-term goals. Now, as you take a look at this case study, if you haven't had this kind of analysis done, you'd like to have this kind of modeling done so you can see the trade-offs, make sure you go to the show notes. There's a link back to our website. You can find out how you can get the gap analysis. It's a complimentary conversation to learn more about this kind of iterative process. Now, that is the beginning of the conversation. So part of their decision-making is going to be, well, Do we want to have all the capital gone? Do we feel comfortable with this investment mix? Maybe reduce some of the expenses. So it's this iterative process where we look at the different trade-off discussions that ends up being the real power behind these kinds of case studies and analysis for clients. Now, the big question for them was, okay, so we moved to an asset mix of 35% cash equivalents and 65% equities. So we've barbelled the portfolio between cash and growth. How much more financial risk do we take on when we move in that direction? So let's take a look at that. So what we're going to take a look at is randomized returns. So we don't live in a world where people are getting 5.78% per year, every year, right to age 90. So in this model, we are aligning the returns to actual. So we are assuming over the length of the analysis between 2025 and 2054 that Sam and Sally are going to get the 5.78% on average, running a 35%, 65% portfolio between cash and equities. But how they'll get there will be variable. And you can see in the red line here, this is the equity part of the portfolio. It's actually underwater a little bit in the early phase of their retirement. So this return sequence can be positive or negative. So if I retire and I get hit with a bit of a negative sequence of return, that could have a long-term impact that could be negative on the portfolio. And this is the trade-off. So we've gone from a risk-free portfolio to now a portfolio that has short-term financial risk. And if I get some negative return patterns in the early years, that could be negative over the long term. And so let's take a look at the model, see what it looks like longer term in terms of the impact of this sequence. So we're going to apply and run. So let's take a look at the actual numbers in the model. So one of the interesting things in the model, you can see the inflation rate is variable every single year, 3.1, then 1.5, then 5.2, 1.6, 4.6. So there's variability in terms of what has to come out of the portfolio every year based on the inflationary impact. And if I take a look at just one of Tom's portfolios, we'll see what the sequence of return is. You can see here the first year is -2, then 1.68, then -11, 9.3, 12.8, 12.8. Basically break even at 0.41, -1. So there's quite a bit of variability. At the end of the analysis, the overall portfolio does generate the 5.78% return that was used in the previous model, but it's a non-linear model. So that sequence could happen in various ways. If I go back to this chart, you could have a sequence of return that, the returns aren't negative here. They might be negative earlier on or at the midpoint of the report. However, no client, when they're beginning to design a retirement portfolio, is concerned about a negative sequence later on. They're always concerned about, how do I deal with a negative sequence here, and do I have the necessary safeguards to deal with that negative sequence? So when we take a look at the report, I'm just going to show you what the impact is. Let's just go back to the charts, and we'll just see what the summary charts show us in terms of the impact of this negative sequence. So if I go back to the chart, you can see right away that there's the impact. We begin to see shortfalls in the 84th year. So this negative sequence basically put us back to the point where we might have been had we had just a risk-free portfolio. So all financial assets have basically been used going out to age 82 in this particular model. Not a great outcome. And this is a really important discussion to have with every client. So keep in mind that when we take a look at this negative sequence, those shortfalls in the model are there if the client keeps spending through that volatility and doesn't adjust their situation. So one of the things we say to clients is, number one, always have a cash wedge in your portfolio to deal with market volatility. Always have a line of credit to deal with market volatility, and have budget flexibility. So clearly, Tom and Sally have budget flexibility. So they've got their ideal budget, but they could spend less during periods of market volatility. Secondly, they should have at least 2 to 3 years of money for income allocated to a cash wedge or an income wedge, so that if they hit a period of volatility, they have cash they can access and they don't have to sell assets at a bad time. So keep in mind, this model doesn't make that distinction. It just goes into the portfolio and it keeps selling off assets in both good years and bad years, whereas at a practical level, Tom and Sally will adjust their spending. And then lastly, have a line of credit in place. So as long as you have budget flexibility, line of credit, and you've got the cash wedge, you'll be able to defend yourself against those issues. But this is the importance of the discussion, right? So when you look at your planning and you go, well, 3.5% is not enough, how do we adjust the mix? Okay, well, if you get higher returns with a mix that has more equity, you're going to achieve your goals. That's great, but we have to deal with short-term volatility. How do we defend ourselves against that? And another iteration could be less growth in the portfolio, maybe adjust some of the spending objectives, and less growth means less short-term volatility. Now, if you enjoyed this video, there's another video on your screen that you'll enjoy as well that looks at various case studies.